Assalamualaikum and hi everyone. Welcome to another presentation on MFRS 140 investment property. This presentation will be exploring the work example 4, which is on the transfer of investment property to the owner occupied property. So how do we account for the transfer of IP when the IP is using the fair value model, and on the date of transfer, the IP that use fair value model is now going to be converted or classified as PPE, that will adopt revaluation model. So we are looking at example 4, and for your information, example 4 is the last example that I'll be doing for transfer of IP to PPE. Example 5 and 6 is a self-study example, so you can always do it, and if you have any problem, you may write down your comment, or perhaps you can just let me know. Right. So on 1st of January 2006, the carrying value of the building which qualifies as investment property. So this is telling you that on 1st of January here, I'm writing it here, 1st of January X6. So what happened is that the building is an IP. And the initial cost of it was 3.2 million. So the cost is 3.2 million. Drawing a timeline will help you visualize what happened better. So that is my personal advice. Right. On 1st of October 2006, the company decided to use the building for admin purpose. So if you can see here, the year end, the beginning of the year was 1st of January, and somewhere here, which is on 1st of October, so I will write it here, 1st of October, during the current year, X6, there is a transfer. So basically there is a transfer or change in use. Change in use is here, so therefore it is being reclassified. Reclassification of the investment property. If you look at the requirement, so you go straight away to the explanation of accounting treatment that were asked from you. It was for the year ended 31st December 2006. So this is the year end 31st December 2006. So meaning to say that within just some 9 months after you have acquired that as an IP, it is converted or reclassified as they have decided to use the building for admin purpose on 1st of October. So that is where IP is being transferred to become an PPE. Right. The fair value of the property on 1st of October, fair value of the IP on 1st of October was 3.5 million. Remember, the company uses here, if you read the question, it is the policy of Sinar Berhad to adopt fair value model. So here is talking about the subsequent measurement, and the subsequent measurement of investment property here is fair value model. So if you can still recall, under fair value model, there is no depreciation. So there will be no depreciation for this 9-month period, because no depreciation as the changes in fair value, if there is any. So the changes in the fair value model, it will be treated as gain, or maybe if there is any changes, it can also be treated as loss. And this is not revaluation model, and these changes will go to the SOPR, right? It will go to the statement of profit or loss, right? That is what happened. So the transfer here, the fair value of the IP is 3.5. if you can still recall, the subsequent measurement here, there's one more information for the IP and also information for revaluation model that was for PPE. So for the PPE, now it becomes PPE. Under PPE, it adopts revaluation model. So changes in the fair value would have been taken into consideration. Depreciation will still continue, but the changes under revaluation model, if there are any changes, that would be treated as revaluation surplus or revaluation deficit. That starting from 1st of October until 31st of December, that is a PPE, but throughout this period here, this is still an IP. So the date that is very important is the date the transfer took place. So transfer starts here, the transfer. So if look, what you have to take note is what is the carrying amount of the PPE on this date. So according to the standard, it says that the carrying amount of the PPE would be the fair value, the previous fair value, the most recent fair value of the IP on the date of transfer. So on the date of transfer, this is the fair value of IP. Okay, so now we have to find out what is the carrying value of the PP, of the IP. On the date of transfer, the fair value is 3.5 million. So let us look at the carrying amount of the IP before that. This is the carrying amount because the cost will now be the carrying amount of IP. Carrying amount of IP is 3.2 million. So the difference here is 0.3 million. This difference is showing that the fair value is greater than the carrying amount, and this changes is a gain, and these gains will be treated in statement of profit or loss as fair value gain. That is what happened. So you have to close or you have to eliminate the item investment property. So under the revaluation model, what you need to understand is that the fair value of the IP now would be the carrying amount of the PPE, which is 3.5 million. And starting from 1st of October onwards, you are going to provide depreciation. So you need to find out what is the accumulated depreciation for this 3-month period. How much is the depreciation? So that is one thing that must be done. So you need to find out how much. And to find out that, you will take 3.5 million, right? That would be divided with the expected useful life. So here you are informed the remaining useful life was 20 years and the company adopted month-to-month depreciation. So divided by 20, multiply by 3/12. So that will give you the first depreciation, which is also the accumulated depreciation. And that will give you a 42,750. So this one is in million, but this one is as the figure is, right? So that is what happened. So the depreciation will start from 1st of October up until the current financial year end, 31st of December. You have to explain the accounting treatment for that. So using this diagram, you should be able to explain the accounting treatment, and it could help you. Where the first one is that you need to explain what happened with the item building. So by building now will be treated as a PPE in accordance with MFRS 116. Give the reason, the evidence, because there is a change in use, and explain what is the change in use, which is from IP to become PPE. So IP to become PPE. So This is the date that is very important, 1st of October. So I'm using a different color here. Next. So the depreciation will be provided as I mentioned, starting from 1st October. You need to put the amount. So I put the amount of RM 43 sorry, it is 43,750 would be provided for the property, and that would continue in the following year. So the deemed carrying amount of the building was the fair value. Building here refers to the PPE building. When it is a PPE, was the fair value of 3.5 million. That was the fair value of IP on the date of transfer. 1st of October is on the date of transfer. So you would see that there is a difference between the carrying amount, which is this one, 3.2 with 3.5 million. The previous cost is the carrying amount on 1st of October. So the fair value compared to that will be giving a figure, will give you a figure of 300,000, and that would be recognized in the statement of profit or loss. So if you were to show some extract of statement of profit or loss, extract of SOPL for that current year ended 31st of December 20x6, right? This is x6 actually, x6. So you would see that there will be expenses. That expenses is due to the depreciation on the building that you just calculated for the PPE, and that would be 43,750. And under the income section or other income, you would also have your gain, which is your gain here, gain on the fair value. That is the 300,000. That was what to be shown in the statement of profit or loss. In the statement of financial position, the extract of SOPI as at the same date, 31st of December X6, you would see that there would be a non-current asset. Right, for 31st of December 2000X6, there is no more IP, but that will just be the PPE. So let's just put the PPE. So I put here PPE, and that PPE, since it is using revaluation model, you still provide depreciation. There are no information about revaluation of PPE, so it is actually the revalued amount would be the fair value minus the subsequent accumulated depreciation. So it is at revalued amount. What is the revalued amount? The revalued amount would be 33.5 million, which is the carrying amount of the PPE, minus the subsequent accumulated depreciation, which is 43,750. And that will give you 345,650. That would be your PPE. However, if you are thinking of what would be on 31st of December 2000X5, yeah, in the previous year, you will not see the PPE. But for that particular situation, because before 1st of October, it was still an IP. So you would see IP in the statement of financial position somewhere perhaps on 30th of June 2006 as well. It is still an IP. It is now a PPE beginning 1st of October, and the first reporting date here is 31st of December. So you show that in the statement of financial position at the revalued amount. So this is the revalued amount. Okay, done with that. So these are the journal entries, where the first one is for you to reclassify the building. Remember, this is based on the carrying amount of IP. and that carrying amount is at fair value since the revaluation fair value model was used. And here is the fair value gain, and the third one is the journal entry for the depreciation. So for that 1 year, when you are asked to show or to explain the accounting treatment for the year ended 31st December, you must explain starting from 1st of throughout this period, 1st of January up until year 6, up until 31st of December x6. So it should be for whatever transaction took place at that particular time. And here we are focusing on the date of transfer as well as the end of the year. So this one I will skip, as I mentioned. And in example 6 is also still under transfer from IP to PPE, but example 6 has some bonus answer. The original question only asks for the explanation for 2000x4, but you would see that there are also explanation which is the bonus answer here for 2000x5x as well. So go and check it out. Now let's move on to the next one, which is transfer from owner occupied property, OOP, under MFRS 140. It is called OOP, owner occupied property, which is using the rules of MFRS 116 PPE, and now it is being transferred to become IP, right? So we are going to look at the start of when is the asset becoming an IP. So under the cost model, what happened if, let's say, the PPE uses cost model and the PPE uses revaluation model? Under the MFRS 140, the standard requires that at the date of change in use, which is at the date of transfer, the item of PPE shall be revalued or remeasured to fair value. So even if you use cost model, let's say throughout the year from the date of purchase, you do not provide any revaluation, no revaluation has been performed. However, if you under MFRS 140, even if you use cost model, only on the date of change, the asset must be revalued or remeasured to the fair value. That is regardless of the measurement model used, either cost model or revaluation model. You are aware that cost model will not take into consideration the changes in fair value, with the exception of when that happens on transfer, and that is only on the date of transfer. For those period before the date of transfer, yes, there is no changes in fair value that you will reflect in the financial statement if you use cost model. So for revaluation model, there is no problem because of course the surplus and revaluation will have come into picture. So any change in the fair value that arise between the carrying amount under MFRS 116. So what is the carrying amount? When it is still an item of PPE, let's say you have it here, 1st of January 2018, and here is 1st of January 2021. Here it is still a PPE. And this is the point where you need to look at it, that is on the date of transfer. And let's say this is 31st of December 2021. So the reclassification date in our case here is 1st of January 2021. So the fair value shall be accounted as revaluation surplus. So the difference between carrying amount on this date versus the fair value, that will be accounted for as per revaluation, which is going to be a surplus or maybe a deficit. You need to think of surplus and deficit regardless the model used. So even if you use cost model, on the date of transfer here is where you still need to go and account that as revaluation surplus or deficit in accordance with MFRS 116. The thunder sounds so loud. Then you have revaluation model, the second one, the second option, which you have accounted for your PPE using revaluation model. The investment property will be measured at the fair value on the date of transfer. Let's say PPE, it uses RM. RM means revaluation model, right? So on the date of transfer, investment property will be measured at the fair value. So the fair value on the date of transfer of the PPE at that time has to be assessed, and therefore that would be the amount that would be incorporated as the carrying amount of the IP. So the fair value of the PPE would be the carrying amount of the IP. Any difference arising upon revaluation, if you use revaluation model, of course, that would be treated as surplus or deficit. However, even if under cost model, it is the same, as long as that is only on the date of transfer. That is on the date of transfer. Right. Let's look at example 7. Example 7 is about Damai Berhad, an entity that acquired 2 buildings for its own use. So you can see the cost of each building was 8 million, right? And you have that information there. So the building were depreciated on a straight line basis. On 1st of January, so this is the date of acquisition of that 2 buildings, where each of them cost you 8 million each, not 2 is for 8 million, but each of the building were depreciated on a straight line basis. So what we are doing now is that the PPE is adopting cost model, and it is now going to be transferred to become IP on the date of transfer, where because that is a change in use. The building were depreciated on a straight line basis over 40 years. So this is the expected useful life. And on 1st of January X4, the fair value of the building was given. And again, 1st of January X7. So this information is best if you can have that on your papers. So let's just do that. And you have here 1st of January X7, where you have acquired a PPE. So this is a PPE building, where you are informed that the building here, the fair value of each building was 8.4 million each, right? So let's look at what you have. So the expected useful life is 40 years. So for each of the building, remember you need to do it separately. You need to look at what happened on the date of transfer. So the date of transfer is the date where the fair value of each of the building happened to be 8.4 million. And on this date is where one of the building, not all, one of the building was rented out. So that was a change from PPE to IP because it was rented out to non-related organization. So we are just focusing on that PPE, and the cost of that one unit that will be transferred is 8 million. And you have what first revaluation that took place, which is on 1st of January X4. On 1st of January X4, that is after some 3 years of providing depreciation. 1st of January X4, so here after 3 years, so you provide depreciation here, and there was a revaluation. So the revaluation here gives you a fair value of 7,215 million, and this must be ignored. Why? The company uses cost model. So remember, it uses cost model. So the depreciation would be provided, but no changes in fair value will be accounted for. So you need to find out what is the carrying amount here, which is cost minus accumulated depreciation. There is no need for you to go and find out what is revaluation surplus, because this is not yet on the date of transfer. And then on here, which is on 1st of January 2000 X9, which that is another 5 years, right? 5 years. You have decided that the building will now be transferred, so that this is the date of change in use, DOT, where the PPE will be transferred to become IP. So you need to find out what is the carrying amount here, right? What is the carrying amount here? And according to the standard, on the date of transfer, the building must be revalued. Yeah, so this is what being mentioned here. On the date of transfer, it requires that the item of PPE must be revalued regardless what was the measurement model. So on the date of transfer, you need to go and find out whether there is a surplus or deficit by comparing the carrying amount with the fair value. The fair value on this date was given 8.4 million. So when you compare this, if you have any difference here, this difference will be treated as either revaluation surplus or maybe a revaluation deficit. So we need to go and check surplus or deficit. Why? This happened to be on the date of transfer. That is on 1st of January 2000 X9. So you need to go and find out what is the carrying amount here by taking cost and finding the accumulated depreciation here, which is for the 3 years. After you have got that, you will be able to find the carrying amount that is on 1st of January X4. So you need to find out this, and this. Right. Then you need to go and find out the carrying amount after 5 years. The same thing by using also cost minus accumulated depreciation. However, this is the date of transfer. The asset will cease to become a PPE, and from this point onwards, the thunder is really loud. It will become IP. So this is where it will become IP from 1st of January 2000 X9. But here it is still a PPE. Here it is still a PPE. Here you will still provide depreciation, right? You provide depreciation for the 8 years. But starting from 1st of January 2000 X9 is where you stop depreciating, and that asset now will be depreciated if it's using cost model for the IP, and therefore if it's using fair value model, the depreciation will stop. But if you assume this using cost model, so you will continue depreciating the asset for investment property. So let's look at what we have explained there in words. One of the building will be reclassified to MFRS 140 IP on 1st of January 2000 X9. Why? Because there is a change in use from owner occupied to being rented out. So that was the evidence, number one. The second one is, sorry, that was the first one. Let's look at the second one. The second one is the information about the policy or the cost model. Even though the cost model is used for the owner-occupied property under MFRS 116, the initial cost or the deemed carrying amount of the investment on the date of transfer, so here on the date of transfer, shall be the previous fair value of the property on 1st of January 2000 X5. So on the date of transfer was 1st of January 2000 X5, and you know that on that date, 1st of January 2000, was it 2000 X5? Let us check. 1st January 2000 X9, yeah, 1st of January 2000 X9. On the date of transfer, Here should be X9, right? 2000 X9. So just make a correction there, please. It should be 8.4 million. The difference between the carrying amount of PPE and the fair value of the date of transfer, again, date of transfer was 1st of January 2000 X9. That will result in a revaluation surplus. So let's see how do we get this, starting from the working. First is the surplus on revaluation on 1st of January 2000 X9. How do you do that? First is to put the cost and then find out the depreciation for that 8 years. Remember, for that 8 years that I have divided into 3 plus 5 years, right? So the accumulated depreciation was 200,000 each, so it is 1.6. How do you get 200,000? Because the useful life was 40 years. So this 200,000 is actually taking the 8 million, yeah, divided by 40 years. So you have 200,000 times 8 years. So you have the carrying amount as at 31st of December 2000 x8 to be 6.4 million. And by 1st of January 2000 x9, the fair value, which is on the date of transfer, is 8.4. You will treat that as a surplus on revaluation, although this is cost model applied. Why? The reason is because this is on the date of transfer. Next is the journal entry to record the transfer of building that happens on that date. The first one is to record the investment property, recognize them, and to go and de-recognize the PPE. So the PPE that would be de-recognized would be at cost, and you also need to remove the depreciation of the building that was a PPE. That 1.6 million must be eliminated. At the same time, the difference between carrying amount and the fair value on the date of transfer, this 2 million, will be treated as surplus on revaluation. So that means that if you can imagine this, so-called IP. At first, the IP, the PPE, that PPE, the first item has 8 million, right? And therefore now you go and transfer them with 8 million, and that would give 8.4 million. 8.4 million. This will go to the IP. This is the one that you have as at the balance brought down that was 1st of January X9. So IP was being transferred to IP 8.4 million. The difference here would have to be related to accumulated depreciation and also the revaluation surplus. But that is no requirement for us to do the account. I just skip that. You can try and do it and go and find out. So under revaluation model, this is the answer for revaluation model in case the item is the question here. The first one is assuming you adopt cost model. The second one is assuming you adopt revaluation model. Under revaluation model, the building will be treated as investment property also on the same date, 1st of January 2000 X9. But bear in mind that now the revaluation model is being used by the company starting from the date it was having the first subsequent measurement. So the revaluation that took place even before the date of transfer, the one here, yeah, must not be ignored if you follow the revaluation model for PPE. So you need to go and find out what was the first surplus or first deficit, and on the date of transfer you need to find out again what is the surplus and deficit, and what is the accounting treatment as per the revaluation model under MFRS 116. So you need to go and take into consideration the fair value changes that happen throughout the date, even before the date of transfer, since you are using revaluation model. So let us look at this situation for revaluation model. So any difference on the building carrying amount and its fair value, this will be treated in accordance with MFRS 116 PPE, treated as surplus or deficit, and this is on the date of transfer and also before date of transfer. Why? The company use revaluation model is being applied for the PPE before it was converted or reclassified as IP. So let us look at whether there is first revaluation or second revaluation. For your information, the first revaluation or the initial revaluation took place on 1st of January X4. So the usual way that you have done for your PPE will be done here. First, find out the cost of that building that was being transferred. Find out the accumulated depreciation from 1st of January X1 up until 31st of December X3. That will give you 600,000. You will get the carrying amount as at 1st of January 2000 X4 to be 7.4 million, and then will be compared with the fair value 7.215, and that will give you the first deficit on revaluation, where first deficit you will debit your statement of profit or loss with 185,000, and you would credit your item here building 185,000, and this is showing the deficit. The second revaluation, this is the second revaluation. The second revaluation, you would have been informed that the fair value was 7.215 million, and the second revaluation, sorry, this is actually the carrying, the fair value now would be the revalued amount, the fair value, which is from the previous fair value. You will start depreciating based on the revalued amount that is at fair value 7215, and then you will continue depreciating the asset. So after 3 years, 40 minus 3, so you have 37 years left, times 5 years, because that is after 5 years, 1st of January X4 until 1st of January X9, right? Next, you get 975. The carrying amount on 1st of January 2000 X9 is 6240, and you have the fair value 8.4. This is on the date of transfer, and this is on the date your transfer from PPE to IP, the date of reclassification. So these are the journal entries that you need to pass to record the transfer of the building. Where first is for you to take note, this happened only on 1st of January 2000 X9. The accumulated depreciation of the BPE building for that 8 years must be eliminated. So that was 975. The accumulated depreciation that was 975 is for the 5 years, sorry, 5 years, because the first revaluation has eliminated the depreciation for the first 3 years. So record that elimination of depreciation. The second one is to record the revaluation surplus. Remember, the rule under MFRS 116 is that you need to first do the reversal of deficit. So the total surplus was 2160. The surplus first would have to be reversed against the deficit of 185, and the remaining will be then credited to the asset revaluation reserve of that particular building, and this is the one that is being reversed and this is the one that was credited under ARR of that particular building. Next is to do the reclassification from IP building to PPE. This is the fair value on the date of transfer that would be the one being incorporated as investment property. However, for the PPE building, this is the one that will be eliminated. Yeah, so you can settle or try and do that in your T account. How do you eliminate that? But I've already done that halfway for you. Right, we can try and finish it off. With that, I'll stop this presentation. For example 8 and 9, we'll do it on a separate video. I'll see you and I will see you. Thank you for your attention. And until then, Assalamu alaikum and bye-bye.